Welcome to The Explainer. I'm your CPA instructor, and today we're diving right into your expedition briefing for Area 2. Now, just a heads up, Area 2 is literally one of the two largest and absolutely most vital parts of the entire BAR exam. But hey, don't worry, we aren't doing deep math on any single topic today. Instead, we're building a map. We're going to look at exactly how Area 2 works, what topics actually live inside it, and most importantly, the specific mindset you need to pass.
Here's our roadmap for today. We'll start with a quick welcome to Area 2, map out the topics, dive into the Area 2 mindset, walk through a 6-step framework, apply that framework, and finally cover some common traps to avoid.
Section 1. Welcome to Area 2, the bridge from technical to reporting.
So Area 2 really represents the technical accounting and reporting core of the BAR discipline. Now, if you've already studied FAR, honestly, Area 2 is going to feel incredibly familiar. It relies on that exact same foundation. But here's the catch, and it's a big one. FAR focuses heavily on the mechanics, right? Journal entries, basic calculations, your standard accounting rules. BAR, on the other hand, makes it much more applied. The examiners want to see real application and analysis. You're no longer just calculating a number. You're analyzing a complex contract to figure out if and when that number is recognized and exactly where it lives in the financial statements. They are absolutely going to test your ability to interpret results, compare alternatives, and reconcile balances.
Section 2. Mapping the topics. The terrain of Area 2.
Let's look at the first major group, asset and liability measurement topics. This covers things like goodwill and indefinite lived intangibles, internally developed software, revenue recognition, stock compensation, research and development costs, and of course, leases. Now, why do these topics live in Area 2? Well, because they all require some heavy interpretation of terms. The examiners just love testing the nuances here. Take internally developed software, for example. You literally have to analyze which specific development stage the project is in before you even know whether to expense or capitalize the costs. Make one wrong interpretation about a software phase, and boom, your entire balance sheet is totally off. Or think about revenue recognition. You aren't just blindly booking a sale. You're actively applying the 5-step model to complex contracts to dictate the precise timing of that revenue.
Then we have our second group, which focuses heavily on entity-wide impact and reporting. We're talking business combinations, consolidated financial statements, derivatives and hedge accounting, public company reporting, and employee benefit plan financial statements. This group is all about testing whether you really grasp the big picture. Like, can you eliminate reciprocal items to avoid double counting in a consolidation so you're viewing them as one single economic entity? Do you actually know the strict SEC disclosures under Regulation SX and SK? Can you accurately present a benefit plan's net assets? The focus here is always on the final reporting consequence, proving you understand the rules well beyond just a standalone entity.
Section 3. The Area 2 mindset, thinking beyond the entry. If you want to pass Area 2, you've got to adopt a truly interpretive mindset. You need to be constantly asking yourself why a specific treatment applies and how it ultimately alters the final financials. A massive recurring theme that tests this mindset is defending whether something should be capitalized or expensed. Basically, deciding whether an incurred cost provides future economic benefit, so it's capitalized as an asset, or if it only provides current period value, meaning it's expensed immediately. A perfect example of this is research and development. Say you buy materials or equipment for R&D. You have to stop and ask, does this have an alternative future use? If the answer is yes, you capitalize and depreciate it. If it's a no, well, no asset goes on the balance sheet and you expense it immediately. The whole accounting treatment completely hinges on your interpretation of that asset's future utility.
Another tension you'll constantly navigate is fair value versus carrying amount. Measuring an item at its current market-based value at a specific date versus its historical cost less amortization. This is a crucial theme when you're eliminating reciprocal items in consolidations, analyzing derivatives, or measuring consideration transferred in a business combination. The exam will frequently, and I mean frequently, test whether you know which exact measurement basis to use on a specific date. Why is this so important? Because using historical cost when you are legally required to use fair value won't just lose you a few points. It completely ruins the reality of your financial statement impact. You absolutely have to know what value goes where and exactly when.
Section 4. The 6-step framework, your navigation tool.
Because BIR demands such applied reasoning, you really need a reliable method to tackle it. I want you to memorize this exact 6-step mental framework. Step 1. Identify the core transaction or reporting issue right from the fact pattern. Step 2. Identify the governing concept. Are we dealing with a lease, a derivative, stock comp? Step 3. Determine the timing and measurement. Basically, when does this happen and at what value? Step 4. Determine the correct accounting treatment. Step 5. Determine the financial statement effect. How is this actually hitting the balance sheet or the income statement? And finally, Step 6. Determine the disclosure or reporting consequence. Every single time you must systematically walk through these steps. Never ever stop just at the journal entry.
Section 5. Applying the framework. Field testing the compass.
All right, let's field test this compass with Scenario 1. Alpha Corp grants stock options to a non-employee consultant, but the contract explicitly stipulates that the options only vest upon the successful delivery of a custom CRM platform. So, what dictates the accounting treatment here? Now, I know accountants love math, but put your calculator down for a second. Notice how this situation requires a strict interpretation of the contract terms before any numbers can even be crunched.
Let's apply our framework to this. The core issue here is a non-employee share-based payment. The governing concept, vesting conditions based on performance. So, following that logic, the correct treatment is that compensation cost simply cannot be recognized until that specific milestone, the delivery of the CRM, dictates the timing. See what happened there? By applying the framework, you realize the timing of recognition hinges entirely on interpreting that performance milestone from the contract, not just blindly jumping in and calculating an option pricing model.
Let's move to Scenario 2, testing business combinations. Omega Inc. acquires Delta Co. They pay $500,000 in cash, and they also give up equipment that has a carrying amount of $50,000 but a fair value of $100,000. The question is, how is the total consideration transferred measured? Can you isolate the correct measurement basis for this one entity reporting event?
Let's run this through the framework. The issue is consideration transferred in an acquisition. The governing concept is fair value measurement at the acquisition date. Because of that, the correct treatment is that the equipment given up is measured at its $100,000 fair value, absolutely not its book value. This makes the total consideration $600,000, and that is incredibly important because that $600,000 figure directly impacts your calculation of goodwill or a bargain purchase gain. If you miss that concept, your final reporting effect is entirely wrong.
For our final example, let's look at employee benefit plans. Imagine a company sponsors a defined benefit pension plan for its workforce. Beyond the basic statement of net assets available, what specific operational reality must drive the plan's disclosures? This is a scenario where treatment, measurement, and specific disclosure requirements all intersect perfectly.
Applying the framework one last time, the issue is defined benefit plan reporting. The key concept here is that defined benefit plans promise future fixed payouts based on complex estimates, which is very different from defined contribution plans that just depend on investment performance. Therefore, the disclosure effect is that the plan absolutely must disclose extensive actuarial assumptions. We're talking discount rates, expected returns, and a detailed breakdown of the components of net periodic pension expense. BAR expects you to connect the fundamental nature of the plan directly to its required financial statement disclosures.
Section 6, Common Traps to Avoid, the Survival Guide.
Listen up, because the absolute biggest mistake you can make in Area 2 is suffering from what I like to call journal entry reflex. That's when you jump straight into the math without carefully reading the contract terms and the fact pattern first. Other big blueprint booby traps include confusing expense versus capitalization rules, missing subtle timing differences hidden deep in a contract, and blurring the very distinct rules for measurement versus consolidation versus disclosure. But above all else, never, ever just stop at the calculated number. You always have to answer how that number actually impacts the balance sheet or the income statement.
Remember this, technical GAAP knowledge is absolutely necessary, but on the bar exam, it is just not enough. You must connect the accounting treatment to the final reporting impact. As you dive into your studies, I want you to always ask yourself, are you just recording history, or are you actually interpreting the true economic reality of the business? Keep that mindset sharp, master the financial statement effect, and I'll see you in the next explainer.